Hello all, I'm Aurel David and welcome again to Adventure Terrain Ventures. Today we are going to talk about gaps. Basically, what is a gap is just the price difference between one day's opening price and the previous day's closing price. So basically, these gaps are a result of a great imbalance between demand and supply. Now, in the last few videos, we spoke a lot about demand and supply and its imbalance. And we also spoke about, an explosive move. Now, a gap is the most explosive move. Would you agree? It's a very explosive move. So it is either there can be a gap up or there can be a gap down. Now, what you see here is prices moving down, closing over here, and the next day opening over here. So in between, no trades have taken place. So such a situation, we call it as a gap. And this is an example of a gap up because the opening price of the next day is above the closing price of the previous day. Now, once a gap is formed, next day, if at all the prices start coming back, then we start talking about gap being filled. As long as the gap is not filled, we call it as an open gap. But the moment the price starts coming back down, and even before it reaches the close of the previous day, we call that the gap is almost being filled, but it's still an open gap. Once prices closes below or goes below the previous day's closing, then we would say this is a filled gap. So in gaps, we are going to use various different types of gaps, but we're not going to get into that discussion right now. But in the course, the Stock Market Model Street, we'll be talking in great deal about gaps. But I will just briefly mention two types of gaps that we discuss in the course. And in continuation to what we discussed last time, that imbalance in price is caused mainly by institutions. Now, what you see here is price coming down and closing here, and next day gapping up. So this kind of a gap where the price is gapping in the opposite direction of the previous few days move can only be caused by big institutional players, don't you think? Because only they will have the capacity to cause the price to move in an opposite direction. So these kind of gaps, we call them as the pro gaps, or they are the gaps which are caused by professionals. Usually we can utilize these pro gaps as very good trading opportunities. So what I tend to do is, if I see price retracing back into this area of demand, okay, this is now an area of demand because prices were coming down, it paused for a while, then it moved higher. So now we have an area of demand along with a gap. So this kind of a setup is a very favorite setup of mine, and if at all I see prices coming back into this area, I would like to take long positions. I would like to buy. Let's talk about another type of gap. Now, when prices are coming down, as you can see, it's been coming down, it closes here, and the next day it gaps down. So in this case, compared to the previous example, the gap is in the direction of the previous move. The previous move is in a down move, and we are gapping down. So these kind of gaps are usually caused not by institutions, but by novices, or we can call them the retail traders. Now, how do we know that these gaps are not caused by institutions and by retail traders? Yes, if you remember in the last video, we spoke about the mistakes that retail traders make. What is the mistake that retail traders make? They usually buy or sell after a move in price. So here what they are doing is they are selling after a down move in price. And that too, they are selling in an area where the chart clearly shows us that demand exceeds supply. So again, if at all I see a novice gap of this nature, I would like to take a trade in the opposite direction of the gap. Now here we are gapping down. So my trade would be to take a long position. That means I would like to buy here. Few other points to be borne in mind while you see gaps in the charts. So in the context of a higher time frame downtrend, if you see a gap up into an area of supply, this would be a great shorting or a selling opportunity. So when I go to a higher time frame chart and I see that we are in a downtrend, and then when I come back to the lower time frame chart and I see an area of supply, so you see an area of supply right here, prices moving up, pause for a while, then a sharp move down. So this indicates an area of supply. So when prices are retracing back into this area of supply, you see a novice gap here. So prices moving up and a gap up. So a gap in the direction of the prior move. So such kind of an opportunity is a great selling opportunity. So you can think of taking short positions in the context of a downtrend. Similarly, when you have a higher time frame uptrend and you see a demand zone being formed, and when prices are retracing back into that area of demand, if you see a gap down, which is a novice gap again, this would be a great buying opportunity. You can think of taking long positions over here. So that's basically a few things which I could just pick up with regard to gaps, but there are a lot more that we can talk about gaps. And in our stock market model street module, we will be getting into great depth about all different types of gaps and how they can be utilized for trading opportunities. Okay, so now let us look at some charts. So here is a trade which I took last week, or rather this week. This trade was planned almost 1, 2, 3, 4, 5, 6, 7 days back. So you need to really have patience, for waiting for the right opportunity. It's not that, okay, now I want to take a trade, let me buy and sell something right away. It's about identifying an opportunity, believing in that opportunity, and waiting for that opportunity. So here I had identified an area of supply. Why? Because you saw that prices were moving down. This is an hourly chart. So for 2 hours, you see the price is in a very narrow range. So what happens here is, prices are at equilibrium. So demand and supply in balance. Now on the third candle, you see a sharp drop in price. Now this kind of a drop in price could be only caused by the professionals, the institutions. So they would have sold a pretty large quantity here. And usually what happens when they sell such quantity, they are unable to sell all the quantity they wanted to sell. So they would be waiting for prices to come back to that area of supply to sell more quantity. So I would always like to follow what institutions are doing. So since this is the origin of the fall in price, I would like to wait for this area. So I mark this area with a red, stating that this is an area of supply. I decided to go short at 92.15 and kept my stop just above the area at 92.90. So prices did come close, but did not really get into my entry price, and it was hovering around here for a very long time, for so many days. So you may be wondering, do I really keep on opening my chart and looking at my chart every day to see if prices have come there or not? I don't really do that. So I use price alerts to identify when prices are coming back very close to my area of supply or my entry price. So I normally, just before prices come there, I keep an alert, so that once I know, once I get the alert, I know that prices are near to my entry price. And then what I can do is I can go open the chart and I can see if the zone is still valid, or is there some changes that I need to make to my entry price, or should I skip the trade altogether. All this I get to do the analysis only when prices come very close to my zone, and then I get a price alert. So probably in another video, I'll talk to you about how to set price alerts. Now, if you observe very closely what happened on this day here, so very early in the morning, if you can see, this is an hourly chart. So all this action is of the first hour of the day, that is from 9:15 to 10:15. As you can see, price opened low and went higher. It went higher, just gave a fill into my sell order, and then collapsed down again to close below my target. So within the first hour, I got my entry and I also got my target. And if you also observe one more thing, my price which I sold was almost the high of the day. So do people tell you like it's not possible to catch the highs of the day and the lows of the day? Think again. Is it possible? I have done it here. We are selling at the high of the day. Of course, I got in and got out with my target getting achieved. After that, prices went back up again to that area of supply, touched that area of supply, and then had a nice big down move. Of course, it was not on the same day. That was the next day the down move continued, and then then we again had a gap down. Now this gap is in the direction of the previous move. So this is a novice gap. So we just discussed about gaps, right? So we can see in the live chart an example of a novice gap here. So, we saw prices move all the way down. Of course, if you are trading in futures and if you are holding the short position overnight, you could be actually holding all the way till here, because even if you kept trailing your stop loss, you would be making many times the risk that you took. The risk is a very small amount of risk. Okay, so the risk is only 75 paise. The stock price is 92, so it's less than 1% risk, right? So we take a very small risk and then we take a trade. So this is actually a low risk, a high reward, and a high probability trading opportunity. Let us now look at the chart of the Nifty. So we've been looking at this supply zone for the last couple of weeks. And I've been always mentioning that, this supply zone should cause the price to drop. And you can see that the prices touched the zone once, dropped, then it moved higher into the zone, and then again dropped. It was, just hovering around this area of supply for quite some time. And then finally, we had a very big fall in the last 2 days. And prices collapsed into this area of demand, which I had marked last week. Now, over here, you can see, if you observe very closely, prices moving up, an up move in price. Then suddenly you see a gap over here. So prices closed here and next day opened lower. So what you see is a gap. So to recap, what's the definition of a gap? It's a difference between the open of today and the close of yesterday. So if you see, if this is today's candle and the previous day's close, this difference is a gap. Now, how would you classify this gap? Would you classify it as a pro gap, or would you classify it as a novice gap? So since we had an up move and we are gapping down, so the gap is in the opposite direction of the previous move. So this is definitely a pro gap. And as discussed earlier, a pro gap into an area of supply is definitely a good trading opportunity. So the fill of this gap could have been a good area to go short. So as you can see, just before we had this big fall, prices went all the way up, very close, almost filled this gap, and then you see a sharp move down. So it would be a good, again, trading opportunity here to go short almost at this peak. So you may be wondering now, oh, is it a good time to buy because we are in an area of demand? Yes, you can think of taking long positions here because we are in an area of demand. However, you need to keep your stop loss for all your long positions at 10,550. So this 10,550 was not breached today. It came very close to that. Okay, but we didn't breach that. The low is 10,557. So we have not breached this demand area. But once we do breach the demand area, in case on Friday, that's tomorrow, if the prices come below this, then I would consider this demand as violated, and I would not consider that for my analysis anymore, and all I do is then go lower to find the next area of demand. So the next area of demand could be here, because you see there is a drop in price, then there is a pause here, and then we have a move up. But this is not a very quality setup. However, you could take some long positions at this area of demand, but we will consider that once this demand is violated. We also have a new area of supply that has been formed here. So let me just draw that new area of supply. So you see prices dropping, a pause, and then a sharp fall in price. So this is a newly formed area of supply. Oops, wrong color. There we have it, the new area of supply. So when you see prices coming back into this area now, you can think of taking your short positions again. So this is how we dynamically monitor the demand and supply zones as new levels of demand and supply keep getting formed on charts. So levels do get violated, and we need to look for new levels. But then buying and selling in or very close to these levels are a low risk and a high probability trading opportunities. So it's a good idea to learn more about demand and supply and candlesticks and gaps, right? And surely we will be going over it in great detail in our class. So I would suggest you to visit our website, that is adventureterrainventures.co.in. Get all the details of the stock market model street module and get started and join us in our course. Anyway, it was nice talking to all of you. Till next time, see you. I'm Aurel David signing out.